If you're changing jobs or preparing for retirement, one of the biggest financial decisions you may face is what to do with your company-sponsored retirement plan. For many people, that account has been building in the background for years through steady payroll contributions, employer matches, and long-term market growth. But once you leave an employer or move into retirement, the process stops being automatic, and the decisions become much more important. This is where many people make a costly mistake. Many costly errors happen because people treat this transaction as paperwork instead of planning. They think they're just filling out a form, moving an account, or checking a rollover box. But in reality, they're making a decision that can affect taxes, retirement income, investment flexibility, and even estate planning opportunities for years to come. And that's why this matters so much. You may have several options when it comes to your retirement plan. In some cases, you may be able to leave the assets in your current plan. In others, you might move them into a new employer's plan. For many people, rolling those assets into an IRA creates more flexibility and more control. And in the right situation, a Roth conversion may create meaningful long-term tax advantages. But there's no universal best answer. The right decision depends on your age, tax bracket, income needs, other investment accounts, and what role those funds need to play in your retirement plan. What works well for one person can be completely wrong for another. For example, a rollover to an IRA may open the door to more investment options and more customized distribution planning. A Roth conversion may help create tax-free income later in retirement. On the other hand, taking a lump sum distribution without fully understanding the tax consequences can create a very expensive surprise. And that's one of the biggest concerns we see. A lot of investors focus on where the money is going, but they don't spend enough time thinking about how the move affects the bigger picture. Will this increase taxable income this year? Will it reduce future required distributions? Does this create a better income strategy in retirement? Are there tax saving strategies available right now that may disappear once the transaction is completed? Those are planning questions, not paperwork questions. Recent changes to required minimum distributions and early withdrawal rules have made these decisions even more important. The rules evolve, tax laws shift, and what made sense years ago may not be the best move today. That's why it can be so valuable to slow down before making an election. That is, a decision that looks simple on the surface can have ripple effects across your entire financial plan. If you're approaching retirement or transitioning to a new job, this is a good time to review your options carefully and make sure the decision fits into your broader tax and income strategy. For more insight into the strategies available when accessing your employer-sponsored retirement funds, download our free guide, 6 Options for Distribution from a Company Plan. You'll find it below this video. If this information raises more questions, we're here to help.